Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of these patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Chicago soybeans. There had been here two main patterns on this daily chart, one driving the market higher longer term and one pressing lower in the shorter term. Both of these patterns are now broken and we have some resultant successful fallout from the moves lower. The first was a very shallow March to early June bear channel. Not an ideal pattern, but it did fit in with the recent action, just about. It is also below what had been some considerable congestion formed over March and early April between roughly 1170 to 1193. This move lower was all prompted by the weekly key reversal down made 6 weeks ago, which formed the peak of a small, if imperfect, head and shoulders top, or even a nascent diamond top pattern. The follow-on low from this move reached the targets for both the head and shoulders top and the diamond pattern, making a key break lower 2.5 weeks ago, not only below the December 2020 low at 1143, but more importantly, breaking down below the main showrunner for this market since August last year. The dark blue lower time, currently 1154.5 of the second major pattern here, a consistent big picture item, the dark blue December 24 to August 25 bullish Andrews pitchfork. I said on this move lower 3 weeks ago, and I quote, "This now leaves us not only this pattern compromised, but it opens the way for a test of the gold long moving average below, currently 1124 3/4, first time since the start of January this year, as well as possible tests of the 61.8% absolute Fibonacci line at 1105 3/4 and a pair of 50% Fibonacci lines at 1100 1/4 and 1098, end of quote. Since that statement, prices have dropped down to the long moving average and started to stabilize, potentially for a further move lower, or as a possible bearish halfway rotation, but it is too early to say if this is true right now. Now I also added 2 weeks ago, and I quote, "With this move down we can look at the whole March to day action as a possible wide double top, Adam and Eve type," end of quote. I added a week prior to this, so 3 weeks ago, and I quote, "We have even today gone so far that I feel obliged to lay out some targets below for this pattern, with a primary target X down at 1114.5 zone, just under the gold long moving average, and a secondary harder to reach target X1 down in the 1078.5 zone. This could be quite a large move lower, as there is limited supports below now, so watch carefully," end of quote. 2 weeks ago, prices reached the primary target X, and whilst it may be that the gold long moving average is acting as an attractor, it's also worth considering 3 other supports below that might be obstacles in the way to target X1. They are, first, and I think possibly the strongest, 61.8% absolute Fibonacci line at 1105 3/4. Second, the 50% Fibonacci line of the August 25 to March 26 move at 1100 1/4. And third, the 50% Fibonacci line of the May to August 24 move at 1098. These last two are close enough together that you can regard them as, I think, one congestion between 1098 and 1100 1/4. However, even looking at them this way, I still think the 61.8% absolute Fibonacci line is the greater support and obstacle in reaching down to target X1. Chicago soybean meal. Between January to early June, the market had moved up nicely within the main pattern here, the bright red, late September 25 to mid-January 26 bullish shift pitchfork. However, 2.5 weeks ago, prices broke down through the bright red lower time, currently 323.60, as well as below the mauve medium moving average, currently 316.40, and as well as congestion between 309.40 to 311.20. Most recently below the slowly rising gold long moving average, currently 308.10, and testing below this the important 50% Fibonacci line of the 25 to 26 move at 302.10, reaching it but not as yet breaking it. I spoke about such a move lower 3 weeks ago when I said, and I quote, "Below this, well, apart from the congestion from January this year between 293.5 to the 50% Fibonacci line at 302.10, well, there is nothing much, and I should say with the overhang of the market since February this year, I could easily see that being tested." End of quote. Thus, this move down from what effectively was a January to early June bull channel left us with some targets below, of a primary target in the 305.20 zone, which has already been reached, and a secondary harder to reach target X down in the 292.90 zone. This secondary target X would be a significant drop close to the lows of this year, though not perhaps as hard as it first seems, as there is little support apart from the congestion from January and February this year down at those levels. It all depends if prices can punch down and stabilize below the 50% Fibonacci line at 302.10. If we do, watch out for the possibility of a further move lower, the whole late May today action looking like a possible bearish halfway hesitation. This leads me to my final point, and this commentary would not be complete without my discussing a portion of my commentary which I have been repeating here for 160 weeks, so for 3 years now. It is the annual key reversal down seen here at the end of 2023. I said back then, and I quote, and I only need to remind you once again of my words when I pointed out the Chicago soybean meal was about to make that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023 and been living in the shadow of this pattern ever since. End of quote. I've also added ever since, and I quote, "If there is only one thing you have taken away from any of my musings, let it have been those words." End of quote. For 3 years, the shadow of that pattern has darkened the skyline of this market ever since. I wondered if prices were now finally exercising that shadow. Not exercising, but exorcising that shadow. Once again, it does not seem to be so, as we are significantly below the close of 2023. Chicago soybean oil. There is one pattern here that has defined moves higher this year, even when it was being thoroughly tested. It is the bright pink March to August 2025 bullish Andrews Pitchfork, with the market today just above the bright pink middle time, which is currently at 67.28, and either side of the rising mauve medium moving average, currently at 68.35. The most recent pattern formation was a turn of May into June horn top that is part of a mid-April 2-day lopsided double top. The latest move low was prompted by the horn top, negating an earlier weekly key reversal. The primary target for this double top was reached last week, but the harder to reach secondary target X down at 64.85 is still there, though target X is stuck in the lower end of a congestion dating from March this year, and I'm having some doubts if prices will drop all the way down there just yet. None of these retires my last statement on this market for the past few months, but it does temper it. I said in the past, and I quote, "I think for this market the question is not whether the market is bullish or not, but how bullish does this market choose to be." End of quote. This is now the 6th week, and the bullish incentive has indeed been heavily dampened, but still not as yet completely extinguished. You only need to look at the pink middle time support to see that, and then the pink lower time below, currently at 58.39, and its close associate right from the start back in December last year, the rising gold long moving average, currently at 59.67. However, there's still one developing factor that may be a significant impact on this market. You see how we're set up now with only a few days to go to form a monthly key reversal in this market. Thus, if we close next Tuesday either over 76.09 or under 74.54, then we would be on. Anything in between and we have a lesser outside month pattern. Right now we are looking very much at a monthly key reversal down, with all the possible implications that may have. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.